And so there is a bit of maturity coming through the dairy pipeline because of that difference, but it's definitely been a challenge. It's inherent basis within the physical that can't be managed directly by the futures without sort of a bit of tweaking. But the upshot is that the futures market does correlate nicely, so we can manage risk reasonably nicely. We just have to be aware and sort of, it's not perfect, but nothing in life is, right?
I'm Matt Cooper, and this is Bite Sides. Welcome to the latest edition of the Ausfine Bite Sides podcast. Very close friend here in front of us from across the ditch. We'd like to say that we're good friends, us Aussies and the Kiwis. Sometimes that's debatable, but let's go with we're friends for today. We've got Stu Davison from High Ground Dairy, superstar broker from High Ground with us today. Stu, welcome to the podcast.
Thanks for having me, mates. Yeah, it's really good to be here. And yeah, we might be competitors on the rugby field, but we're mates anywhere else outside of the countries. Come on.
Us Anzacs.
Yeah, exactly.
Exactly right, mate. Exactly. So great to have you here, and thanks for coming into the studio. As per usual in these, it's great to get someone's background. So what's the Stu Davison story?
Yeah, where do we start? I think the key place we start is in the dairy industry is grew up on a dairy farm in the Waikato. Mum and dad operate, at their peak, they operated 5 dairy farms. So
wow.
Yeah, pretty decent sizes. So most of them were 600 cow plus.
That is a big...
Yeah,
big undertaking.
The old boy was pretty keen on leveraging and getting as big as he could. Had a few business partners through the time, and sort of built his empire pretty well. He's still working away there with the brothers on farm.
Still with the 5?
We're down to 4 at the moment,
okay.
So we've consolidated a little bit recently, which is cool. Definitely easier than running a few less and closer to home was a lot easier. But that was childhood, growing up on a farm, used to big operations, used to things going crazy, keeping up what's going on in the markets. Live in the Waikato, grass central of the world. If you can grow grass in the Waikato, you know how the rest of the world operates on that front. So that was really key, formative years, and then off to Lincoln University in the South Island in Canterbury to do my agriculture degree there, which was formative again. Actually went home and went farming for 8 years after that. So
right,
ran.
When you're growing up as a kid, were you actively involved in the farm then, like learning the ropes?
Driving a tractor since I was 8. Milking cows since I was 12 or 13.
Sure.
Running farms on school holidays, the whole gambit. Relief milking across the sort of area we lived in. Dairy farmers in the blood.
Okay, so you know the industry from putting on the cups.
Yep.
Up. Yeah. Okay.
Right through. Yep. Yeah. So
fantastic.
That sort of Lincoln degree, and then going back home, running the farms. Actually ended up share milking and contract milking in New Zealand on my own. So me and the wife went out on our own. We ran 3 of Dad's farms for a while. Went on our own for a few years after that. Owned the cows on one farm, contract milked on another, had our own runoff. So we had a decent operation on our own.
How old were you at this point in time?
I think we were 27 at that point.
It's a lot of responsibility for a young couple.
Yep. Yeah. The wife was pretty dragged along.
Had she been on a dairy farm?
She grew up on a dairy farm too.
Okay.
So
so it was in the blood.
The milk runs in the blood, which is good. But no, so that was key. We were doing that, and then we had a bit of an upset with one of the farm owners when we were running our own thing, and a job came up at NZX as a dairy analyst, and that was really cool because we saw an opportunity to move off the farm and into the other side of the market that we had always had a huge interest for. Obviously, going through uni, you sort of look at both sides of the market. You think you should be focused on the farm, but I had this massive passion for what happened off farm as well. And me and the old man used to talk a lot around the business, world markets. What influenced milk price in New Zealand? What did it mean for the farms? All those sort of what's going to happen to the farm next year? What's happening in China? What does that mean?
Could I ask real quick question? In your studies at Lincoln, is that part of the syllabus? Is like learning about
yes, to a point.
The hedging side of the world.
Hedging was pretty small in the scheme of things. I actually went back later in life after I went to NZX, did a master's in finance. Okay. And so that had a very good derivatives portion in it as well. Yep. And that sort of fueled the fire. But I did a lot of economics and commerce when I was at Lincoln, along with pasture science, all the fun things, all the agriculture, how to run the farm. So that was cool. And so long story short, NZX lit the fuse for where we are now, 3 years there. and then got scooped up by High Ground with an offer to cover for maternity leave for our friend Alyssa Badger, and that was the entry into the team. And then the proviso was, working with NZX, going to High Ground was, if I'm coming to High Ground, I want to be a broker. I can't do what I want to do at NZX. So I can build the market, but I can't, participate in the market. And so High Ground said, come across. If you want to do that, go and do it. We'll support you. Learn from one of the best in the industry, Eric Meyer, and also the High Ground trading team. And they've just been supportive as anything from there. And so they've let me free, and here we are in the big old world, standing a book up with the SGX market, and helping clients across the world manage risk and understand the market.
Fantastic. So you're based in Auckland
now?
You?
No, I'm based in Chicago now.
So you're across in Chicago, so with the rest of the High Ground team there?
Yep.
Okay.
So I'm US based and trade the Singapore exchange at night. So not a lot of sleep happening.
No, that's pretty disturbed sleep there.
Yeah, correct.
When did you make that move across to the US?
We started, again, the US, you've got to have a visa to get in, right? So when I turned up, it was sort of intermittent for the first year, just come and go as needed. We applied for the visa the first day I was with High Ground, and we got accepted straight away. So once that got sort of printed into the passport, October 23, we ended up permanently in the US, and then just back and forth from there. So the wife's recently got a job at University of Wisconsin up in Madison, and so she's set in the US system as well. So we're keeping her happy with her career happening as well.
Okay.
And being in Chicago, drive between the two, sort of here, there, and everywhere. And like today, I'm back in Melbourne. I was here a year ago, and so my job is pretty all over the place too. So Chicago is the home base at the moment, but sometimes I find myself in Canterbury, the Waikato, Melbourne, Singapore, you name it.
Excellent. Now, we have had a podcast with another broker, and I got some feedback that I was spoken jargon and there was some assumed knowledge there.
There we go.
So could I just ask you really, really quickly to just give us a crash course for those that aren't as familiar with this world as to what is hedging and how the hedging world works?
Yeah, for sure. I think the key here is to get around the jargon. Is the point of hedging is to remove market risk. And so it doesn't matter if you're a dairy farmer managing milk price risk, or if you're a processor managing cost of goods or sales prices, or you're a buy side managing the cost of goods for your products you're manufacturing. The whole market is exposed to market risk. So hedging is removing that market risk through the use of a financial product. In the world of dairy, we use derivatives, futures options, be that on the exchange or OTC. There's a few avenues there, and without getting into the jargon, but we use.
It's easy to slip into, isn't it?
Oh, you just go straight down the ramp. Yeah, but we use those financial products to manage the market risk of the market.
Yep. So just really, really quickly, a future is a contract at a future point.
Yep.
That's settled at a
time of the. Yep. Correct. Yeah. So a future settles to a physical product or price index that you trade today and settles in the future. That's where it sort of derives its name from.
Yeah.
It's the contract between a buyer and a seller on the exchange, facilitated by the exchange. So, for example, we've probably mentioned the jargon already: SGX, the Singapore Exchange, the CME, the Chicago Mercantile Exchange, for example, and other commodity exchanges are applicable there too. But that futures contract is a financial situation. It's really key to understand that the financial is equivalent to the physical in terms of pricing. They settle to the same thing. We have a thing called convergence. And so as the physical price moves and settles, the future settles to the same point. And so you have, for the best part of time, you have little basis. And so, a contract with low basis settles to a nice physical, perfect. And so that sort of ability to hedge with a product that you're exposed to, really handy when you're, Kiwi dairy farmer. Milk price risk is quite large. That milk price future that's offered on the SGX settles to the Fonterra Farmgate milk price. The basis on average is quite small. Same with a whole milk powder future on the Singapore Exchange, or a cheese future on the CME. So, those contracts settle to the commodity that you're trading.
Yep. Thank you for that.
Good.
Well done. It is interesting, though, because the ability to hedge in commodity world has been around for a long time. If we think about grains or coffee or whatever it might be, pork bellies is famous in trading places. That famous movie. But for dairy, it's relatively recent. To be honest, which is quite amazing when you consider the amount of risk that is taken on in our industry for as long as we can remember. It's quite phenomenal. It took quite a while for us to get our heads around it.
It is, and I think when we think about the Oceania and Asia tranche of the world market, the SGX is still in its infancy. CME is a lot further ahead, sort of 20, 25 years if you think about where the maturity of that market is. But like you said, you compare it to the corn markets in the US, which are 1855, they got stood up in Chicago. And so,
is that right?
That's
1855.
Right. Yeah.
Holy guacamole.
Yeah. So the CBOT, good old historical birthplace of futures markets. But that's the thing. So that sort of development in the corn markets, very commoditized. Took a long time to get into the dairy markets. And now we're here. The market is no less volatile. If anything, it's actually getting more volatile.
Yeah, sure.
Especially on the commodity front. And so it's prime time for the market to stand up, but uptake is still lagging slowly.
Yeah, it's. Would you say, because it's quite often my contention that dairy is somewhat unique in that it's not really a true commodity. In the sense of the closest thing we've got, I guess, is skim milk powder. But even then, there's nuances to origin, there's nuances to factory level, even if it's the same company producing skim. They may have three different factories that the skim's produced at, and some might be quite different in the way that the skim kind of comes to market. So would you say that's a contributor as to why the uptake's been a bit slower, as to find where that commodity point is? Yes. Yeah, and exactly right. And we go back to our corn situation, right? Corn's corn. Corn's corn. It's a kernel. It's pretty straightforward. There's definitely some arguing around where it is and all this sort of, that situation. But dairy's challenge is that skim milk powder, the most fungible market we have, definitely, reasonably tight. But you add a bit of moisture, you move the protein, and someone argues the price differential is not the same. How much basis do we count the futures market? That conversation gets really hard when you go to cheese. What's the standard? Where does it come from? How's the basis going to work? That's the problem. That is the sort of pushback from people. But the market's solving that situation too. Index trading, for example, is helping if we fix the sales price to the futures market, or the thing that settles the futures market, buyer and seller then agree that, even though there might be something different in the actual physical product, we agree on the pricing is set to that. And so there is a bit of maturity coming through the dairy pipeline because of that difference, but it's definitely been a challenge. It's inherent basis within the physical that can't be managed directly by the futures without sort of a bit of tweaking. But the upshot is that the futures market does correlate nicely, so we can manage risk reasonably nicely. We just have to be aware and sort of, it's not perfect, but nothing in life is, right? No, definitely not at the moment. That's for sure. No. I guess just thinking it through further, I guess because it's going through quite a profound process. Whatever dairy product we manufacture is going through heat treatment and drying or adding starter culture, be it cheese and whatnot. Whereas other commodities, they may go through a small level of processing, but not to a great extent. No. The one that is probably closest, the one aspect of dairying that's closest to it is milk. Which brings us very nicely into your kind of area of expertise, which is the milk hedging in New Zealand. Could you just give us a little bit of background on how that came about and how long has it been around and how the uptake's been? Yeah, well, so the key here is that, New Zealand obviously very exposed to the world market. Fonterra milk price for even before it was Fonterra, that sort of milk price was given to farmers, annualised. Commodity risk from the world market was fed straight back to the farmer's pocket. And that basically bore the whole market. The whole brunt. Market risk came back to the farmer. The farmer in New Zealand bears the entire market risk, and it's I actually pull it out in one of my presentations for people in terms of the Fonterra supply agreement is the farmer agrees to bear commodity risk. Is that actually written? That's written, And so that's within legislation within New Zealand too. Okay. So the DERA legislation in New Zealand says You are taking the market risk.
When we removed subsidies in the 80s, that was the start of it. And then when we got to DERA in 2001, that was the next level of you as the farmer is accepting responsibility or bearing the commodity risk. The processor bears the sales and collection risk.
So just to kind of put that in context, how much of New Zealand's milk production is exported?
Depends how you do the equation. It's north of 95. My math says about 97%.
So just to explain that, so the exposure to the global market is so profound.
Yep, correct. Yep, and so that's the kicker. It's a very unique market on that front. So let's take the US, for example, where the bulk of the milk produced is consumed in country. Exports are a tiny fraction. Let's go to China. Let's go to anywhere actually in the world. The majority of the milk is consumed in country. It doesn't get exported. Maybe some skim, some byproducts here and there. New Zealand is a unique individual that 97% of those milk solids produced in country get exported out.
Yeah, quite an amazing stat.
Oh, it's ridiculous. Yeah, but it's ridiculous because of the amount of risk that the country takes.
Yes. Then getting back to the farmer, bearing the majority of that.
Correct. And so that's why the futures market basically got stood up. So the NZX team will 100% correct me if I'm wrong here, but about 2016, the futures market for milk price got lifted, and then basically it was 3 contracts, so the current season, the season ahead, and then the third season ahead of that, and the contract settles to Fonterra's farm gate milk price at the end of the season, so September every year. And so the milk price future is really important to understand too, because it's a basket of the commodities on the exchange as well, and also sold on GDT. So whole milk powder, skim milk powder, buttermilk powder for unfortunately, anhydrous milk fat and butter all combined into the basket. We've got to take some costs in there in terms of what the nominal processor in New Zealand needs to process those milk solids, exchange rate, and then it prints out a New Zealand milk price. And so that's the combination of the ingredients futures to the milk price, and farmers can use that milk price future to manage the revenue risk or the market risk for their farm.
Okay, so just to put it in layman's term, I'm a dairy farmer in New Zealand. I'm getting a current price of X. I look at the future, that's Y. I kind of like that. Mm-hmm. That's more than what I'm getting right now, so I'm going to basically take out a futures contract.
Correct.
At that higher price, I'm going to lock in my known, so I'm actually have now just de-risked my income stream.
That's right.
Now I can go out and make some purchasing decisions on farm or feed.
Yep, exactly right. Yeah, and so that ability to go out and sell their risk into the futures market, we've got willing buyers on the other side willing to, same thing, they're exposed to that milk price risk one way or another, be that a processor in New Zealand or a trader somewhere else in the world, they're willing to take the other side. So the farmer can make that risk management decision. The market trades 5 days a week. It's a good 12-hour session, good Kiwi time zone, and they understand that market risk because that's the price they dictate their situation on. And so, before the futures market existed, the conversation was always, I wonder what the milk price is going to be. It's going to be X, it's going to be Y. Nobody actually knows. What are we doing about it? Nothing. What can we do about it? Nothing. How are we farming any differently? We're not. So
so true.
So all you have to do is cast your mind back to that $3.90 payout in very recent history, 2015, 2016. That hurt farmers dramatically in New Zealand. A lot of people took a long time to farm their way out of that situation. It was well below cost of production. That is burnt into the memory of farmers in New Zealand, and that's a big driver of the uptake of these futures because they go, well, I don't want that to happen. So let's manage this risk. And that sort of maturity of their business is helping that too. Sort of consolidation, farms are bigger in New Zealand. That means they've got more revenue at risk. They've got more loaners, more debt on the shoulders. Land prices have only gotten better. And so you see that sort of value at risk increase, and the uptake of futures is really impressive as a result. So, it's good. It's growing.
So just to put in context for people, again, who aren't as close to the industry as you and I, $3.90 a kilo in 2015. Just to put it in context, what's the current price for milk in New Zealand?
Currently, so we're probably trading about $9.70 for the New Zealand milk price this season.
So less than 10 years ago, and it was $3.90. It was just to put that in context, that was a bad time.
Last year was north of $10. So we've bounced a long way from there, and that was pretty grim.
So you said this futures market was established 2016. So 10-year anniversary now. What from what you saw, how is the uptake from farmers from the early days to where it is now? Was there a lot of suspicion in the early days, or was it embraced pretty quickly?
Yeah, there was a little bit of trepidation from the average farmer. The corporate end, if we use that term in New Zealand, so the bigger, more complex operations, they saw the value really quickly, and they were cornerstone as well. So some really big farmers, they jumped on, saw the value, got involved, and so that was really key. It lifted the market pretty quickly. We also had the NZX had already lifted the whole milk powder, skim milk powder contracts as well, and the AMF and the butter contracts on the futures market. So there was a bit of a basket or a crush trade available for speculators as well. So there was some natural liquidity coming. But over time, with the big farmers getting involved in the market, sort of eking its way into the mindset of the New Zealand dairy situation, the awareness just grew naturally. And so now, the average farmer in New Zealand looks at the milk price futures market as an understanding of where the market is. They might not be trading, but they look at the market to understand where the market is. And so that's a big sign of the maturity and growth we've had in that time frame since the contract started. Participation grows every year. My phone's going red hot trying to, clients wanting to paper to start a new brokerage account. Get on and manage.
What time's that phone call come through? About 2 a.m. for you?
24 hours a day, mate. It's endless. It's sort
in
of
Chicago.
One day stops and the next starts. It's good.
Sorry, I interrupted your flow.
No.
So lots of interest, yeah.
Lots of interest, but it's good. That sort of you work with farmers, you got to be ready to sort of go whenever they want to go because their time's very precious. But the kicker is, as they see farmers see volatility, they see the advantage of these contracts as well.
Yeah, for sure. What do you think, if you had to put a percentage in it of farmer participation now, what do you think it'd be?
If we do like milk solids, as when we think about milk solids as the market, it's about 7 to 15%, depending on where the market's been in the last while. And if you add other, so we've got the futures market, this is going to confuse some people too. We've got other offerings as well. So Fonterra offers a fixed milk price for its farmers. Other processors do similar. And then there's swaps as well available in the market too. So we sweep all that together, we might get closer to 20-25% of the market on a really good year.
Yep. So that means that if you put that into context, still 75% that are playing the old game of
correct
bearing all the
risk. Yes, correct.
So there's a lot of upside there as new participants come in, more experience in these types of financial offerings.
And it is, and it's the understanding of how the market works for the farmer. You're short a product, so they're naturally long the product the whole time. They're short. One thing is they know the milk price situation well, what the drivers are. They've then got to understand how a futures market works for them. And so margining for them is a bit of a challenge in terms of how do I cash flow that? Again, it's an annualized contract. So they're cash flowing that volatility through the season. They haven't actually been paid their physical at the same time. So they've got to remanage their cash flow. They've got to have conversations with the banks. Banks in New Zealand are very supportive because it de-risks their book, which is good. But it's a conversation of margin financing. Once they see that, they start looking at options and go, options are really nice because there's no margining. Yep, let's go for options. And so they build those structures into the situation, outright futures, the whole gambit. And so it's really cool to see that growth. But it's like any lifting any market. It takes time for the participants to learn. They have a go, they get in, and they just keep growing and growing and growing. So it's really growing at a good rate. The hard thing is get enough time to get everyone papered.
Yeah, which is good position for you.
Oh, it's great. Yeah, can't complain.
Except for the sleep patterns.
Yeah, it's not my problem.
And for those people not familiar with margin calls, maybe Google it.
Yeah, exactly.
And you'll get an understanding of why that's a big impact on cash flow.
Correct.
Okay, let's come across the Tasman.
Okay. Perfect.
Here we don't have any type of hedging mechanism for our farmers or our processors here. Similar situation to what you spoke about historically. Farmers are bearing a hell of a lot of risk.
Oh yeah.
Although a lot of that has been de-risked with recent dairy code.
Yep.
And now a lot of it's been borne by the processor. But the risk is still sitting there with the inability to hedge.
Yes.
You've got a 12-month exposure to a guaranteed milk price. Which is problematic from
to say the least.
from one season to the next. If you were going to roll out a similar situation as far as a milk price hedging program to Australia,
Yep.
how would you do it? Or what are the key components? What are the pillars that you would need to put in place to make it successful? And then how would you go out to market there's a lot to, I guess, just to backtrack a little bit, there's a lot of distrust.
Yes.
I feel with any type of program like that's hedging, that the farmers, I think there's a natural reluctance to embrace something like that. So what pillars do you think need to be in place for to overcome that?
Yeah, and let's go firstly. The trust thing from anyone trading futures is key, and so, but that is a cornerstone to building a market or a tool or a product, derivative product especially. And that sort of leads to the first answer: is you need to have an index price or a physical price that is open, transparent, operated by someone that's not involved in the processing and collecting. So the reference there is GDT. And so GDT in New Zealand, I'm going to say it slower, the global dairy trade for everyone out there. In New Zealand is the sort of benchmark platform that sells and prices commodities in New Zealand. That actually prices all of New Zealand milk as well. Yep. So the milk price calculation comes from that platform. That's the transparent hub of physical sales. And that's a really important factor for the futures market to back off. If you don't have an index price that's trustworthy, transparent, the futures market won't be traded because...
So how do we do that here from an Australian? Because the product mix is quite different here than what it is in New Zealand, and it's much more fragmented with different processes and stuff. So
100%. So, and that's the situation of you need to have a set of indexes or price mechanisms, be that, we have futures markets in the world or they're more OTC accounts that are traded on an index. And so it's not a platform or an exchange. It's sort of a survey price, for need of a better term, run by an independent operator. They survey the market, they collect prices, weight them to make sure they're not, one person pushing too far the other way. And that index is used to settle futures contracts. So that's another operation in terms of understanding the mix, surveying those prices and putting out. The bottom dollar here is that you need to have reliable pricing mechanism across the products that are being produced and the avenues of risk that are presented to the farmer. And so, the Australian mix is a bit more cheese than it is in New Zealand. And so how do you price that in? How do you have that cheese exposure? And how do you price that back to the farmer? What else do you put into that? It's not easy, but it's a complex situation that has to be put together to get to the outcome of hedging. Yeah.
And in your experience with working with New Zealand farmers, and I don't know if this is unfair, but as I mentioned, my experience and observations is there's a reluctance to and a distrust of these types of financial products.
Yep.
How do you overcome that with farmers?
Yeah, and it goes back to one of my earlier comments too. Like once they've tried the situation, they understand it, but the trust is born by the market understanding. So again, you got to remember, Kiwi farmers have had since 2008 watching GDT and it priced their milk prices through time.
Yep.
So they have that inherent trust of that's the situation. I can see it. It's transparent. I know what's going on. The futures market then is the next part of that is how do you convince them that they have a portion of knowledge in the market too? And that's really important when you think about why would I trade a futures contract?
Yep.
If I have a portion of knowledge within the market, I can trade on that. And farmers forget that they have one of the biggest part of a futures market is supply. Kiwi farmers know what the weather's doing. They know how much grass is grown in most of the country, and so they have that supply side of the market sort of understood. They can trade on the back of that as well. And so, you sort of put this information that they have, supply them a little bit more information in the market, have a trustworthy index that they can measure off, and the trust starts to build from there. A lot of it is also education. And so, to be honest, it's, like myself, sitting down with farmers and going through what is the risk they're exposed to, what happens offshore, what does it mean for your revenue, all those bits and pieces, and building that rapport with them. And again, go right back to the exchange. The work NZX has done in New Zealand to support that education piece for Kiwi farmers is really key too. So the big part is, education builds trust, transparent pricing builds trust. Once you get those two pillars, you can sort of start to see the future of a futures market.
Last question on this point.
Okay.
Could you ever see a market getting up and running successfully in Australia?
Yes. The big kicker there, I think, and tell me if I'm talking out of turn, I think the legislation the legislation that's underwriting the current situation, in my view, probably hasn't worked. The farmers might enjoy the lack of risk, but the processors don't. And so, you've just shuffled the risk across the table. And so I think in terms of if or when that legislation gets changed, the futures market might be an outcome that sort of naturally evolves from that, where risk is borne by both parties and managed by both as well. So it becomes a conversation of, can the industry do it? What does that mean for the future of Australian dairy? Let's put in context, Australia was as big as New Zealand's dairy industry at one point as well, and now New Zealand has well and truly superseded that volume. There's a reliability expectation that if the farmers are to continue, they need to understand that they have access to manage risk, or they know what's going to happen with their milk price. So those things sort of happen and occur through the market itself. But you put legislation in place like we see now, and that dissolves the ability to put a futures market in place.
It does.
Or manage risk in a term that works for the farmer and the processor. The moment you one-side risk in a market, you actually create unintended consequences. And no market works well with manipulation, and legislation's technically manipulation. So it's not good for the long term of a market. And so, for the last few years, watching it from the other side of the Tasman and seeing the legislation go in place, it's definitely been good for the Aussie farmer in the short term, but the long term risk is real.
Yeah, it is. I think it's a fair observation, by the way.
Yeah,
That's the problem.
Yeah,
the risk is moved, but the risk hasn't gone away.
Correct. You never get away from commodity risk. As a dairy farmer or a sheep and beef farmer, crop farmer, there is risk inherent in what you're doing. You are the primary producer. Unfortunately, you're the first step in the chain, and you bear the most risk.
Mate, time has flown. It's been a great conversation, but I do have just a couple of conversations getting back to high ground. So high ground, I don't know its full history, but very much US focused.
Yes.
And now the amazing growth in US exports on the dairy front means that the US industry is a lot more global than it ever has been. You've now come on board as the Kiwi NZX, SGX expert. Just speak just in general terms of what you've seen as far as the more global view of US dairy and high ground as well.
Yeah. I mean, that US dairy piece is really impressive. The growth in that market from production is just unbelievable. Scale has to be understood. You go from the Aussie farm or the Kiwi farm to a Californian farm. Just the mind boggles. So that's really impressive. But also I think that market has managed to support a growing domestic consumption situation as well. Like, you live in the US and there's cheese and everything. So, the market's been supported by policy in the US, and that growth has been really impressive. The US market trying to get into the world of trade is really admirable, but they're realising the challenges too. So they see the value, but they also are learning the challenges pretty quickly too. So really cool to see. They have high quality product, high quality milk. They've been making a lot of cheese for a long time, so they understand the cheese export situation. The whey protein on the back of that's a big story at the moment too.
Crazy.
Oh, it's incredible. That's a whole nother podcast.
Yeah, it is.
It is. But that's the kicker. The US market is very advanced and very large, and they are getting into the world market. I think around that thought out is they're probably going to realise that it's a little bit more challenging than just the skim butter markets and the cheese whey markets. You think about Southeast Asia and how that operates, price sensitive buyers, access, geopolitical problems. The dairy market in the US is getting a rude awakening of what the rest of the world's had to deal with forever and a day. So that's really interesting, but that sort of feeds into the high ground situation as well. Eric stood high ground up. It's going to be 13 years ago now. After a long career, both physical and financial in the market, a lot of understanding of how the US market works, and has helped clients understand procurement and risk and execution and advisory situations, and along with our cornerstone, which is our reports. We run a lot of analysis behind a keyboard a fair bit. As is the whole team, and that sort of ability to keep our clients informed is our cornerstone sort of knowledge base. But the kicker there is, as a Kiwi coming in, a lot of what I've done is actually explain to the US client base that US skim milk powder is actually influenced by the rest of the world.
Shock.
Crazy, right? And so as a US participant in any market, dairy market especially, you need to be viewing the rest of the world and understanding how those influences move things. And so that's been the big bit. And again, going right back to the start of this, being a farm boy from the Waikato, having this accent in the US really gives me some edge. And but that's been the fun part. And High Ground's a great team. You know, we're still only small in the scheme of things. We're agile, we're driven. We pride ourselves in our work, and we work really hard for it. And we just enjoy what we do. We all just love the agri, and especially the dairy markets. And to be honest, the mix with financial markets is just a buzz too. It's great fun.
Yeah, that's great. Keeps you awake at night.
Yep. Yeah, and that's the thing, right? You wouldn't do the work if you didn't love it.
No, that's true.
The team loves it. It's great fun.
Good stuff. And what's next for Stu Davison? World domination in...
Yeah, that's right. Yeah, let's get the SGX book up and running and growing, and away we go. And I, to be honest, the real passion is actually New Zealand dairy. The reason I like doing milk price futures with farmers in New Zealand is that it helps their business. I like to see farm business grow. There's still mum and dad farmers back in New Zealand, so to see them grow and protect their revenue, great result. Really cool to see the market on the other side, processes, be profitable. We need an industry with profitable processes. If someone doesn't turn up to process your milk, that's a problem.
Yeah.
And so, for me, that's the growing that understanding in the New Zealand market, just helping people. And, for me, getting to do what I get to do in the dairy markets is just a dream.
Fantastic story, mate. And it comes all the way back to where you started and helping the farmers. So great story. That's it. We've come to the end of the podcast. Again, really appreciate your time. It's been a great story and great to learn more about your journey.
Thank you. Thanks for having me. It was always great to be here.
Thanks, Stu.
Cheers, mate.